Hi all and welcome to the webinar today. We'll be discussing venture debt. Is it the solution for your startup? So today joining me we have Lachlan McKnight, who is the CEO and co-founder of LegalVision. As an
Hi.
entrepreneur as an entrepreneur with a background in banking and finance, Lachlan is passionate about assisting startup founders to raise capital and grow their business. We also have Nick Gainsley, a partner at OneVentures, who leads the growth credit practice of the firm. Nick brings over 15 years of debt experience, both in direct lending and advisory in Europe and Australia. And you also have myself. I'm Sian McLachlan. I'm a practice leader in our corporate team here at LegalVision, specializing in capital raising, both on the equity and debt side. And so before we kick off, just a few housekeeping matters. So you'll receive the recording and slides in your email after the presentation. Please, if any questions come up during the presentation, please submit them in the chat box, and we'll have a Q&A at the end. We have a number of questions already submitted, so thank you all for those questions, and we will try and get to as many of them as possible. And finally, at the end, you will receive a pop-up to complete a survey at the end of the webinar. So we'd be grateful for any feedback you have on the topic and the content that you've heard here today. We also have, as a special offer for all attendees today, a complimentary consultation with LegalVision. So all attendees today are eligible to receive a complimentary consultation with us to discuss how we can help your business, whether that be putting in place venture debt or any other legal matter you need assistance with. So to claim, please leave your contact details in the survey at the end of the webinar. That's very important. So please put your details in there so that you can claim your complimentary consultation with us. And what we'll be discussing today. So first of all, we'll talk about what is venture debt. Next, we'll talk about common misconceptions. We will then run through the key advantages of debt versus equity, which is probably the other main form of finance that you might be contemplating. Next, we'll talk about the process for putting debt in place. Then some of the key terms that are negotiated, and then following that, Lachlan's going to dive into a little bit of a case study, LegalVision itself being a borrower of venture debt, and we'll finish up with a Q&A. So to kick things off, let's start with what is venture debt. Nick, I'll throw to you here to give a bit of background on this.
Great, thanks, Sean. So what is venture debt? Ultimately, we're providing a flexible funding tool for high growth technology companies. We look for businesses that have already raised VC or institutional backing and have already gone past the initial phase of development. So we're not doing, or venture debt generally doesn't provide very early stage funding whilst you're still building out technology or starting your business. It's at a stage once you've already created something, have some product market fit, and are in that mode where you're scaling. And then it becomes a really useful tool as side by side of equity. It's much cheaper and less dilutive, but you can actually spend it in a similar way to equity. So it's not restricting you on a specific use case. It's pretty flexible. Some example use cases, you may be looking for additional capital alongside equity or between equity rounds to give you capital to continue to invest and reach your goals in your business. We have examples of people who have used it to make acquisitions. So it could be for organic or inorganic growth. It's useful as a tool to give you extra capital for unforeseen circumstances. So you may not know exactly how your business is going to perform or costs you're going to have, and therefore having access to capital without going to raise equity, it's much, it's easier to raise quicker, and it's a good way of funding those things if you need to. It could also just give you headroom in your business. So it could give you headroom to reach profitability. It's just a common use case we're seeing in current market today.
Perfect. And I guess what are some of the common features you see? I know from our client's perspective in terms of what the facility is actually structured like. What's most common?
So normally the loan is structured kind of in two parts. So there's the core loan, which will have a fixed term where you have to pay that loan back. Typically it's 3 to 4 years, so it's relatively short term short to medium term finance. There'll be an interest rate on that loan, so you'll be paying interest, often monthly, and normally you'll be paying down the capital through the life of the loan, so you end up at a balance of zero at the end. And then additionally on top of that, normally, not every provider, but often look for some equity upside. So usually there's some form of equity option or some additional return over and above that. But it actually really aligns interests because the provider therefore wants your business to succeed and build value because they participate in that upside.
Yeah. Okay, cool. We also had a question in terms of what security does someone require for a new venture? I mean, I can speak to this in my experience advising clients. You know, generally venture debt providers are requesting an all asset security. So from the borrower and also from certain subsidiaries, if it does have subsidiary entities. And so that is security over all of the assets in the company. But most importantly, and I think we'll jump into this when we move on to common misconceptions, most venture debt does not require personal guarantees. And so with that, I might ask Lachlan, in your experience as a borrower, what have you perceived the risks to your personal assets as a founder in entering the venture debt transaction?
Yeah, well, I think your point that you just made, that in general, and it's not all the time, but in general, a venture debt provider doesn't require a personal guarantee of directors of the company, means that what's at risk ultimately is the company. And at the end of the day, if you think about that, particularly if you've raised an institutional round with a preference share structure, the venture debt provider is just sitting ahead of the preference shareholders in the liquidation waterfall. As an ordinary shareholder, as a founder, you're generally an ordinary shareholder and you sit at the bottom. And so if the company goes insolvent, whether you've got venture debt or not, you're likely going to be getting nothing in that liquidation. So really, the way to think of venture debt in some ways is not so much as a traditional debt structural debt facility, but just another type of another type of equity. That's sort of how I've always thought of it. And if you think of it that way, the reason why it's interesting for founders of the right type of businesses is that it significantly reduces your cost of equity, and that's the real power of venture debt. And I think it's worth going into a bit of detail on what does that mean. Well, ultimately, the most expensive thing you can do in your business is sell equity. It's the one thing you can't get back. And if you think about a traditional kind of venture debt deal, you might be looking at a low teens interest rate and a warrant on top, which means the venture debt providers may be getting a return of, 25% annualized or something in that range. If, as a founder, you feel like you'll be able to grow the value of your business at more than 25% year on year, then that debt is cheaper than raising equity. If you feel like you can't grow your business at more than 25% year on year, then the debt will be more expensive than equity. Now, if you think about traditional kind of startup space, you're growing the value of your business at hopefully a much quicker rate than 25% year on year. And so the cost of the debt over the long run is a lot cheaper than issuing new equity. And that's really that's the power of it. That's the value of it. There's downsides or not so much downsides, but there are considerations around cash flow that I think are very important for you to understand as a founder, because obviously, as Nick said, you've got to start repaying the principal and interest relatively quickly. So it does affect your cash flow. You need to work out, if it makes sense and so on and so forth. But ultimately, if you've got a project, let's say, as Nick mentioned, a project around, look, we want to hire a bunch more sales team members. We want to spend a whole bunch more on marketing, and our payback period for sales and marketing is 18 months. then the venture debt can be very, very helpful because you're getting that payback within 18 months, and the term of the debt is 3 to 4 years, and so you can grow the business significantly over that period of time, and taking on the debt makes sense. So again, I think it's important to look at venture debt alongside your equity capital raise. It's pretty unusual to just raise debt. Often you'll be raising some equity and some debt, but it's a tool that really is something that all founders of a certain business, I think, should be considering at the very least.
Thanks, Lachlan. And thank you also for explaining the mechanics. I know a lot of my clients, as for startup clients, they are yet to entertain debt as an option, partly because they have concerns in terms of being able to repay. And so I think when they approach equity, that they're looking at that delayed payment as a benefit for their business, but it's helpful to frame it in that sense in terms of debt versus equity, and weighing up whether or not actually debt can be cheaper for your business, depending on how
Yeah,
it's
it's
run.
really the combination. I put it differently. Let's say you're looking at raising 10 million, and you want to raise 10 million. You want 10 million cash to do, whatever you're planning on doing at let's say it's Series A. It's more of a decision of going, all right, well, let's raise 7 of equity and 3 of debt.
Yeah.
You still got 10 million bucks. The cost of capital is going to be lower, and if you can, deal with, from a running your business perspective, deal with the cash flow situation of when you need to start repaying the debt and how much you need to repay, then it can make a lot of sense. But you need to have a pretty good understanding of, your business model, your financial model, and I think that's probably why the sort of debt that the Nick and OneVentures issue is for slightly later stage companies than the real early stage companies. But again, Nick can talk to that.
Yeah.
And I think it's a good point. I think, look, predictability of your business is key. If your business is still finding its feet, still trying to find out the best go-to-market, you're still trying to work out your metrics, then I would be cautious around taking debt, because you're going to have to pay the debt back and things may not pan out exactly how you foresee. But if you're very clear on your metrics, so you've got a machine, you understand how much it's going to cost to acquire a new customer, the payback on that customer, then debt can be really efficient way of scaling business and building value.
Yeah. Nick, can we dive a little bit into the cash flows? Because I think one of the common misconceptions I hear from clients, particularly those that have had exposure to the US market, is, as I understand, or from what I hear, the US lenders, there's a lot of complexity around the interest payments, whereas, at least in my view, I think in Australia, the Australian lenders are quite transparent about the interest costs. Can you give us a bit of an example in terms of kind of the offerings that you would make?
Yeah, look, we think transparency is really important. We want founders to understand what they're taking and what it's going to cost them. So, the way we fund is pretty simple. I mean, literally, we have an interest rate. That interest rate typically is fixed, but we have done floating rates. So you have an interest cost you pay, and effectively every month you're paying interest based off, the starting capital position at the beginning of that month. We try and simplify things, so we wrap up the capital payments and the interest to have fixed payments. So therefore, as a business, you know what that cost is each month. The split between the capital and the interest flexes, very similar to your mortgage, but on a much shorter timeline. So you'll know you're paying X amount per month over, say, 36 months until you've paid off the debt in full. So it's pretty clear around that. There are some fees. Typically, there's a fee to put the facility in place. There's a transaction fee. Depending on the nature of the facility and whether that facility has an open line piece, there may be a fee around the open line. But ultimately, if there's an open line, the way we do that is effectively there'll be an unused amount of capital. If you choose to take down that money, you'll start paying interest on the amount you take, and that amount you take down will have its own term and profile of when you pay it off. So it's pretty clear. The key costs really are the interest, any fees, and then any warrant piece as well, which is the equity option. The cost of the equity option is a bit more unknown, because that will depend on the outcome of your business, but you should have clarity around the size of that, the exercise price on that, which will dictate the number of shares.
Yeah. And that's something certainly that, yeah, we work through with our clients in terms of helping educate them in terms of the commercial, once there's commercial terms are negotiated, like understanding what, if they have offered warrants, what that will mean for them based on those terms. Another question someone had, yeah.
Sorry, Sian, just on the fees, I think it's worth pointing out that when you're comparing a term sheet side by side, say you've got a couple of term sheets from a couple of providers or 3 or 4, it's really important to understand exactly what the cost is, because different providers will have different types of fees. The volume of the fees, the amount of the fees might be the front end fee, for instance, or there might be a back end fee, could be significant, and the interest rate could be quite a lot lower. What you really need to do is work with your CFO or whoever runs finance in your business, or your external accountant if they're an accountant that understands this space, and work out the actual cost of the capital. Now you'll never be able to, as Nick says, you'll never be able to work out the actual cost of the warrant until the warrant is exercised, which is obviously when it's an exit event generally. But you can certainly work out what is the actual annual cost of the debt component. And it's important to understand that, because I do think, frankly, people can go, oh, this interest rate's lower, so I'm going to go with this provider, without actually considering the other fees that go into it.
Yeah.
It's similar to what banks do as well, and mortgages, right? You have your fixed rate and you've got that comparison rate. So think about your APR, AER, what it's going to cost you. Obviously, someone giving you money for a shorter period of time, that's going to make the fees disproportionately larger than someone who gives you money over a longer period, and likewise how quickly you pay down that capital. So there are providers out there who would express an interest rate, and there's people who express a fee which you pay over a period of time. But yeah, I recommend translating that into what your annual cost is, so you can compare.
Yeah.
Yeah. Very important.
And so Sian, I mean, you were getting into the legal side of things. I think it's important for people to understand, if I'm looking at venture debt, and I'm happy with the commercials, I'm happy with the interest rate, fees, I'm happy with the warrant, and so on. And what are the 2 or 3 things from a legal perspective that you really need to keep an eye out for, and make sure that you understand and negotiate if possible?
Yeah. So one of the most important things to look out for in your documents that your lawyer should walk you through are the undertakings that you give in the document. So you'll give your lender will ask for certain things from you, and they usually relate to how the business is run in that period, because obviously your lender wants to know that you're doing things above board and you're doing things in a way which ensures that the loan will be repaid. But it's important to review those and check that they're consistent in terms of what you've planned for the business. So things that often come up in particular are around disposals. So remembering that often your lender will have taken security over all of your assets of the business. But depending on what your business does, say it's a leasing business, you might need to be entering transactions where you won't have possession of your assets for the entire time. And so it's important that you talk with your lawyer, and your lawyer has a sound understanding of your business. And then they're reviewing the documents and checking, okay, can your company give these undertakings, and will it hinder your business or your business plans in any other way? Another thing that often comes up are the provisions that might be in there regarding restructure. So if you're a startup, hopefully you've got big plans ahead. And so it's important to understand for those provisions, and for, if you set up another subsidiary, what kind of consents do you need from your lender? Do you need lender consent? Will that subsidiary need to give security as well? And so that's something that I'm most often looking at. I know OneV as a lender is quite accommodating of different business needs, and so it's just about having that discussion both with your lawyer and your lender up front, and saying, this is what we've planned, this is what is feasible from us, and reaching a position on those points. Another point that my clients are often quite concerned about is, what happens if the business does hit financial difficulty? What does that look like? And so I think this is a place where venture debt can differ from traditional debt in terms of there's not usually a whole heap of financial covenants in there, but there are often some. So it's understanding, well, what do those financial covenants mean for your business? How does it impact your business based on how it's been operating at the moment and how likely are you to trigger those. With that, Nick, I might throw to you just to talk through a little bit more in terms of how 1V approaches things, for a borrower who maybe has, hit some financial distress and is needing to, revisit their position.
Sure. Look, ultimately we want the same thing as you as founder and as other shareholders. Look, we want the business to bounce back, continue on, build value, and ultimately potentially reach an eventual exit. I mean, some businesses may get to the point where they pay dividends, but most are kind of driving towards an exit. We want the same thing. So we definitely don't want a business to end up in some form of bankruptcy. Typically, higher growth, earlier stage kind of tech businesses or businesses generally are building value for the future, and there's not a whole bunch of assets sitting there on the balance sheet. So we want to work with that company to get through the other side. Typically, that means we'll work together and think, okay, well, what do you need to do to correct the business? That may be reducing costs. There could be reductions in headcount or other costs. That could be kind of focusing on part of core aspects of the business. We're not dictating that. Typically, that will be the company thinking about how to solve those things. They may be asking for us, like, is there ways we can, amend the terms on the loan? Maybe new equity comes in alongside that to drive the business forward, but we'll work collaboratively with the management team and shareholders to move through the other side and hopefully come out the other side. Look, sometimes companies may decide that they end up selling their business earlier, and that's perfectly fine. As a lender, we're very flexible and work with parties and kind of go on that journey together rather than being we're definitely not an aggressive party trying to push people into a certain action.
I think that's another point worth mentioning is if you do take venture debt on, generally your venture debt provider is not going to want to be on your board. They might be a board observer, but you won't generally have unlike a VC who would generally want a spot on your board.
Yeah.
One thing that I think would be interesting, obviously, Nick, at OneVentures, you're focused on those startups that have raised some institutional capital that have sort of worked out their business model to a certain extent and have that model in place, and so that sort of makes sense. If you're an earlier stage company, and there are a bunch of earlier stage companies who are founders who are listening in to the webinar, what are some options, some debt options that are out there in Australia now that could be suitable? Do you have any advice?
Yeah, definitely. Look, if you're too early stage to access a product like ours, there are other forms of debt out there. I think the key is what is the profile of your business and what potential assets are there to get funding against? Because if you're at a stage where you haven't got, you're not producing lots of positive cash flow, then it's harder to get a typical lender who's going to cash flow lend. If there's some form of assets there, can you get debt against those assets? So look, a common asset we see is, early stage business investing and innovating will be investing in R&D. They may be eligible for the R&D tax credit from government. There are a bunch of R&D lenders who will lend against that R&D. So that will give you some form of short-term working capital between the point of submitting your R&D claim and receiving that claim. So that can be a short-term funding. You don't have to be cash flow positive. You don't even have to be generating revenue to access that. There are a number of providers out there. That's one option. If you have, significant, if you have recurring revenue, there are also revenue-based finances out there who will provide funding at an earlier stage than a provider like ours. Typically, that money is shorter-term funding, but people may provide, funding against your revenue. They might provide some sort of receivables funding. So if you have large receivables, so you're paid quite lumpy revenue from potentially larger enterprises, then there may be ways of getting receivable funding against those invoices, which will give you another form of short-term working capital. So generally, those providers provide more of a working capital to get you through periods rather than a long-term, kind of longer-term funding.
Yep.
We've just had a question come through in terms of how the presence of venture debt in the capital structure is typically viewed by VCs. Lachlan, I don't know if you've had any experience discussing this with your...
Yeah, I mean, interesting. I wouldn't say so much VCs. What I would say is many years ago when we raised our first, we raised venture debt from a group of individuals. We were raising our Series A, this is many years ago, and some of the, and we actually raised from a group of high net worths for Series A, and some of those high net worths didn't really understand the venture debt structure, were uncomfortable with it, and the warrants as well. And one of the warrants exercised before they invested on the Series A, which was slightly annoying and complicated things. Ultimately made the debt more expensive because we had to kind of do a deal to convert those warrants at an early stage. And so I would say if you're looking to raise from sort of high net worth but potentially not sophisticated investors in the sense of who invested a lot in startups, then it can be problematic. On the other hand, in the VC space, everyone knows venture debt, and almost from a credibility perspective, you're almost more credible if you've got a chunk of venture debt there, because you're showing that you understand the cost of capital, you understand the value of debt, and ultimately, I guess a venture debt provider has done some DD. It's not as much DD generally as a VC would do, but has done some DD and kind of ticked off the business. So I think it depends on the type of equity investor that's coming along next more than anything.
Yeah.
Yeah.
But I definitely echo your. Oh yeah, go Nick. Sorry.
No. So I was going to say, look, add to that, look, generally people are pretty comfortable around debt being there. I mean, the key things to think about is size of debt. Look, if you had a huge amount of debt on the balance sheet, then clearly people are going to be worried about, can you pay that debt back? So that can cause you an issue. Generally, the lenders are going to only provide the amount of debt they're comfortable with. So you probably be okay there. But think about amount of debt. Also, if you had very expensive debt from a certain provider early on, and people might come and go, well, there's so much money going out the door to pay this provider. So it's a kind of a question on who you've taken the debt on, amount of debt, and the terms of those debt. But you can always pay the debt back as well if you need to pay it back early, and there'll be terms around that. So there's flexibility there. But generally, there's a lot of comfort around debt these days.
Yeah.
I'd say it's also fair to say that venture debt often gets refinanced. If a business is growing really strongly, either you'll be going back to your venture debt provider saying, hey, we want to increase the size of the facility because the payback period is so good, there's a real opportunity for us to invest heavily here, and it all makes sense. Or you're getting to a stage where you're so successful that you can get cheaper debt than whatever OneVentures is able to offer, bank debt and the like, and then you would refinance in that way. So I don't know. I'd be interested actually, Nick, how many of your loans actually go through to maturity with no changes versus being extended or refinanced and so on.
I'd actually say like a lot aren't refinanced, but your points around how it changes are definitely true. So you may outgrow this sort of debt because of the profile of your business. So if you start to become very profitable and very cash generative, then you may be able to access more mature forms of debt, potentially back debt. If you, or conversely, you may decide, look, this debt isn't for me. Over time, you'll pay it down anyway. So the structure of our loans is such that you pay it down over time. So it comes off naturally. And there's many situations where people may take on more debt over time, continue to see opportunities to grow, and can take further debt from the same provider. So kind of either you term it out and it gets paid off. If you get sold, it's worth pointing out, if you sell your business early or you IPO, I'm not saying necessarily you're at the stage yet, then you'd most likely pay back that debt early. And there could be situations where, for whatever reason, there's another provider out who's willing to provide you more debt or more attractive terms. And then, in that situation, you could refinance for debt.
Yeah.
I just wanted to move through now. We've touched on a few of these points, but looking at debt in comparison to equity, we've raised a few points in terms of the cost. Lachlan, you highlighted the fact that usually in a venture debt scenario, the lender might be coming on as a board observer, but not necessarily asking for a board appointment, right? Which usually is the case for a lead investor in an equity round. You also touched on DD. So, DD as part of a venture debt round is often a bit lighter. I guess just to continue that point, it is generally people often express a preference for debt in terms of the ease with which that is put in place. So thinking about it, you only have one lender generally to deal with, whereas in an equity round you've got many investors, and so the equity process can take a lot longer. And so I've had a few clients that have lent on debt in that regard because it's much quicker and easier to put in place, and the negotiation is much smoother.
With
Nick,
that in mind, just worth mentioning, sorry, Sian, that
yeah,
that's very true. And what you often see is a very successful startup who's raised an equity round at Series A, Series B, or whatever, and they know they're going to raise a big round in the future, whether it might be in 6 months' time, a year's time, 2 years' time, whatever it might be, and often they'll use venture debt as a bridging bridging round to get them through to their Series C, meaning that, number one, they don't need to go back to negotiating an equity round with equity investors at a stage in their business where they don't want to, but also it gives you the opportunity to continue increasing the valuation of your business over a period of time, while still having the funding there to be able to continue investing at the rate you've been investing. And so, venture debt as a bridge, I think is something that is, probably could be used more, frankly.
Yeah, and I've definitely seen a couple of clients, to avoid a down round. They know that there's some milestone that they need to hit, and at that point, the company value will go up, and so they do use it to hit that milestone, and then conduct their raise shortly after. At which point, they might repay the debt that's in place. Nick, are there any other differences that you can think of, debt versus equity, that our audience should know about?
Yeah, so we've talked about the cost. Clearly, it's cheaper, and you're not giving away equity. I mean, we touched upon it as well, but the fact that it's shorter term or temporary capital is positive. So equity is permanent. You take equity, you've given up part of your business forever. If you see opportunities to invest, get benefit and pay it back, the overall cost, ignoring percentage cost per year, the actual dollar cost is significantly lower because you're crushing that into a kind of shorter period of time. Not having change of control is important. Like if you give away equity, we touched upon board seats, but look, you're giving away voting rights, and you may be bringing another party around the table, which may actually mean as a founder you're losing control, and you may not have given up majority, but you'll start to lose control and influence because you'll have more parties around the table and equity. So there's a difference there. We touched upon speed of execution. I think the clarity on cost as well. Like you should know, debt has a clear cost, whereas equity has a complete unknown cost, but there is a cost there. And I think many founders ignore the fact that there is a cost of equity because they're not actually paying money out. But ultimately, those shareholders are getting value through capital growth mainly. There could be dividends, but generally they're benefiting from the price they're selling those shares at on an event, liquidity event in the future. So that's important. The point you made around valuation is really, really valid and even more valid in current market. So yes, you may be a down round, but it also may mean your existing shareholders may have a different view on valuation to external shareholders, and that's even more the case today in current market. So you avoid those protracted negotiations around cost. The existing shareholders may not want to set a price today either. So by taking on debt, you don't set that valuation. You could also take debt alongside some form of unpriced structured equity. That could be the form of a safe note or a convertible note. It's very commonly used today, and it has been over the last 18 months. So actually, interesting tool that you can therefore package up a good bunch of funding without setting that price.
Although it is probably worth mentioning, like you don't want to end up in a situation, and I think this is a risk for some businesses now in the current environment where you've got a bunch of convertible notes, safe notes, warrants from your venture debt provider, all sat on your cap table, and do you actually have a good sense of what will happen when all of these convert, and what that means for your fully diluted? On top of that, you got your ESOP, where does your fully diluted ordinary shareholding as a founder actually end up? Worth thinking about before you before you use too many of these unpriced instruments.
Yeah,
Sure,
and I think, I've definitely, even for us in terms of the assistance that we provide to clients, we've definitely seen that happen in terms of an increased complexity on the cap table. We've had to expand out our cap table model to accommodate, multiple convertibles on different terms. So definitely something that we do see.
Yeah, I wouldn't recommend stacking convertibles on top of each other, which people do. So like
It
think
happens
about it
more
as
than you think,
a
unfortunately.
a
with that,
one-off convertible round. Yeah, sorry.
Yeah, that'll make your lawyer very happy as well. So with that, we might move through to the process for putting debt in place. We had a few questions in terms of finding investors. So Lachlan, I might start with you and then move through to Nick. But Lachlan, how did you find your lender?
Yeah, well, I mean, we've done three venture debt deals throughout our 13 years of being in business now. The first one was super early on, and it was three angel investors who were keen on a debt structure rather than an equity structure. We were a sort of business that a debt structure made sense for, because we were cash generative from almost from day one. We then repaid that debt when we raised our kind of Series A. We went a few years without any debt in our capital structure. We then raised from another group of angel investors a more substantial amount, and that was great. And then we got to the stage where we decided we wanted to launch in the UK. This was feels like it was about 3 years ago now, maybe. We were keen to launch in the UK. We were generating a good amount of, significant amount of cash flow here in Australia, but to launch in the UK, we would require a significant investment. We didn't want to raise equity, and so that's when we went to Nick and OneVentures and negotiated an institutional venture debt deal that was flexible, enabled us to borrow a chunk of money up front, but also left open the possibility, and we had a substantial amount that was available for us to draw down on if we decided we needed it. And that was very important to us, because we didn't really have a great sense of how much capital we would require to launch in the UK. We knew it would require a certain amount, but we didn't know how quickly we'd start generating cash and get to cash flow break even. In the end, we didn't need. We used a little bit of that, but not all of it. And so that's again, one of those things that I think is really important to think about when you're raising, whether it's equity or debt, is don't the unknown unknowns, I think, is really important. So make sure that you're conscious that you don't know everything, and that there is a good chance that you'll need more capital than you've modelled out. In fact, the way I've always done it is to work out what I think we need and then double it, and that's usually about right. So so we've worked with OneVentures for the last 3 or so years. It's worked really well for us. And how did we meet OneVentures? I think just being in this space for many years, you sort of end up knowing everyone, right? But I think my sense of for those founders out there who are at the stage where they're thinking about venture capital, it's very easy to get in touch with either OneVentures or one of the other providers that's out there, because everyone's looking for deals, looking for good deals. If you're a good business that fits within the lending parameters, then that there's someone who'll want to speak to you.
Yeah. And Nick, how do most people get in touch with you, and also what does that first pitch look like?
Sure. Hopefully it's pretty easy to find me. I mean, you can connect through different people you may or may not know. There's a link on our website where you can send an inquiry. You can message me on LinkedIn. So I'm pretty open in terms of different ways of finding us, or one of the other team members on the credit side here at OneVentures. In terms of that first meeting, look, I think initially it's just really getting to know each other, understanding what the business does and the needs of business, and we can quickly come to a early view of, okay, is it worth pursuing more? Are you at the right stage? Typically, we're looking for companies doing a minimum of 3 million recurring revenue, so scale is important. We're very focused around technology and kind of real differentiated businesses, so it's kind of a prerequisite. And then it's kind of another question around, well, what's the cash flow profile of the business look like? We want to see enough cash in the business before debt and plus the debt to give you time to reach that next goal. If someone came to me saying, look, I've got 1 month's cash, can you give me money? It's going to be very hard. So it's always good to get to know the lender way in advance of needing it and then engage at the right time. We like to get to know people, over Zoom, over a coffee to try and understand the needs, and then we kind of dig in and get a bit more understanding on the business. It's a much quicker process than equity. For us, from meeting a founder, getting to know them and getting a bit of information, we can turn around a decision in 1-2 weeks to get to initial term sheet. So it's quite quick to get an initial view on what it might look like or not look like.
Cool. And how long roughly are you doing due diligence for, and what kind of stuff are you asking for in that process?
Sure. So the initial stage is really probably a pitch deck giving us a real broad understanding of what your business is, where you're at, where you sit in the market. We need some numbers, so some historic numbers around how you've performed and a model forecasting out for, say at least a couple of years forward, so we get understanding of how you expect to trade, and then a cap table to understand the shareholder structure. That's typically what information we need at the very first stage. And as I mentioned, that stage may take 1 to 2 weeks. From term sheet through to close, typically the process is about 4 to 6 weeks. That will include, from our perspective, some deeper DD, meeting some more team members, chatting to your investors. We may talk to some customers, get a bit of better understanding in terms of financial, but also non-financial. So understanding the product a little bit more, market, competitive standpoint, those kind of items. Typically that process, the DD will probably take a few weeks. And in parallel, we'll run the legal process as well. And the legal docs normally comprise a loan, a warrant, and some security documents.
Yeah.
And one thing on that, just worth mentioning, is often you see this on the equity side and on the debt side, is founders who engage a law firm or a lawyer who doesn't really know what they're doing in the space. It's not necessarily the most complex of spaces, but on both the equity and the debt raise side of things, there's a way things are done. There's a market standard. If you engage a lawyer who isn't familiar with that, it's going to make things a lot more complicated. They'll be negotiating things that they shouldn't be negotiating. That they'll be not picking up things they should be picking up. So really make sure that you find a lawyer or a firm that specializes in this space if you're going down the route of raising either equity or debt.
Yeah, absolutely. And on other pitfalls, common pitfalls in this space, one of the most common things that I ask clients to not repeat is bring me a signed term sheet. So I urge you to, if you do have a term sheet, bringing it to your lawyer in draft so they can help negotiate that for you, because those are going to be the key terms set out in your documents. And once something goes into the term sheet, it's very hard to take out in the longer form docs. So it's getting your lawyer involved early, reviewing that term sheet, and then, as Lachlan said, getting someone who has appropriate experience to either review or prepare the documents for you and help navigate that swiftly to a close. Because as Lachlan's raised, if you have someone inexperienced, you're going to be headbutting over points, because it is very different to your traditional bank facility. Okay, with that, we're almost out of time. I might just ask, Lachlan, is there anything else you wanted to add about your experience as a borrower and your experience with venture debt that you think the audience should know about?
No, look, I think the key thing is, there are providers that are looking to do deals at all stages. You have to have a functioning business. No one's going to lend to a business that's just kind of an idea and a slide deck. That's not going to happen. But if you've got a business that's generating, some revenue, and even if it's not that much, there are providers who are out there who are keen to talk to you. So, have a think about where you fit in the range of businesses, and then if you're going to go after target particular providers, do that. Make sure you're targeting those providers who fit with the range that you're in. I think that's quite important.
Okay, great. Thank you. All right, we might whip through them because we've got a couple of last items to cover. But first of all, thanks everyone for joining us. There's a free download to our Venture Debt Handbook, which will be incredibly helpful. There's lots of case studies in there. There's an article in there from OneVentures, so please download if you like further info. Also, don't forget, to join us for our next webinar. So on Thursday the 29th, we have a webinar on work health and safety for in-house counsellors and business managers. So please join at 11 a.m. And finally, so LegalVision, the way that we assist our clients is we work on a membership basis. So our members get access to our team of 100 plus experienced lawyers to help you sort through all of your legal issues quickly. So for a fixed weekly fee, you get unlimited document drafting reviews, unlimited advice consultations, and many other benefits. Our clients find it incredibly valuable. And so if you're interested, please reach out, and please don't forget to also claim your complimentary consult as well. And here are Nick's details. As he said, very easy to get in touch. You can scan the QR code there if you are interested in having a conversation with Nick. Thank you. Thank you all for joining.
Thank you. Bye.
Thanks, everyone. Bye-bye.